Hey everyone, welcome back to the channel. If you're watching this, you're probably wondering, what's up with gold? Is it about to take off, hold steady, or maybe even dip? Because right now, gold is trading around a fascinating $2,440 per ounce. And in the next few minutes, we're going to break down exactly what is driving that number and where it might be headed. Whether you invest in stocks, commodities, or just want to understand the big picture, this update is for you. We'll dive into all the critical factors: inflation, the Federal Reserve, the strength of the US dollar, and global uncertainty. Trust me, by the end of this video, you'll have a much clearer picture of gold's trajectory. So, what exactly makes gold tick? Well, it basically comes down to three big forces. First, there's inflation and the Federal Reserve's policies. When inflation starts heating up, people often rush to gold as a safe haven, pushing its price higher. It's like gold becomes your financial bunker. But then, if the Fed starts hiking interest rates, bond yields become super attractive, and suddenly, gold can come under pressure. Second, the US dollar plays a huge role. Think about it, when the dollar gets stronger, gold becomes more expensive for international buyers, which can cool off demand. And third, global fear. Whenever the world feels a bit wobbly, whether it's wars, bank scares, or political drama, gold steps up as the ultimate safety asset. It's been doing that for thousands of years. Now, let's talk timelines. In the short term, if the Fed keeps its hawkish stance, meaning they regress about fighting inflation, and bond yields continue to climb, gold might just stay under pressure. However, here's the kicker: any hint of banking instability or a fresh geopolitical conflict, that could send gold absolutely soaring. It really is a tug of war. Looking a bit further out, say the midterm. Over the next 6 to 12 months, the biggest driver will be what we call real yields. This is basically bond yields minus inflation. If real yields start to fall, gold typically goes up. But if inflation cools down and real yields stay positive, gold could find itself in a rather flat or even downward trend. It's all about the balance. And for the long term, talking 1 to 5 years, two massive factors will be central bank buying and physical demand from jewelry and emerging markets. Central banks all over the globe have been quietly accumulating gold for their reserves. And that, my friends, is a powerful long-term bullish foundation. This isn't just a trend, it's a strategic move by nations. Alright, let's explore three possible scenarios for gold's future. Scenario 1. The bullish case. Imagine the Fed softens its tone. Inflation starts creeping up again, global uncertainty ramps up, and those central banks keep buying gold hand over fist. In this scenario, we could easily see gold rally anywhere from 10 to 25% higher over the next year. That's a significant move. Scenario 2. The sideways case. Here, the Fed stays pretty neutral, economic data is a mixed bag, and the dollar remains relatively steady. Gold might just trade within a narrow range, becoming a wait-and-see zone for many investors. It's not exciting, but it's not losing ground either. And finally, Scenario 3. The bearish case. What if the Fed stays aggressive, real yields keep climbing, and global growth stabilizes? Then, gold could potentially drop by 10 to 20% as investment funds start pulling out and mining supply increases. It's important to be prepared for all possibilities. So, what key indicators should you be watching right now? If the US 10-year Treasury yield starts to rise, gold could face pressure. If inflation data, like the CPI or PCE, begins climbing again, expect gold demand to strengthen. Pay attention to the dollar index, or DXY. If it moves up for 3 or more consecutive sessions, that's generally a bearish signal for gold. And finally, keep an eye on gold ETF holdings like GLD or IAU. If they show inflows, that's usually a very bullish sign. Just a quick disclaimer, folks. Gold is often considered a safe haven, but it's not a guaranteed profit machine. This video is purely for educational and informational purposes, not financial advice. Always, and I mean always, talk to a licensed financial advisor before making any investment decisions. It's your money, so be smart about it. To recap, Gold's price is a dance between inflation, Fed policy, the dollar's strength, and global fear. In the short term, yields and the Fed's tone dictate the direction. Mid-term, real yields and inflation data are king. And long-term, central bank buying and physical demand hold the key. If you've ever invested in gold, drop your experience in the comments below. I love hearing your thoughts, and I'll do my best to reply. Tone. Don't forget to smash that like button, subscribe to the channel, and hit the bell icon so you don't miss our daily US finance and market updates. You'll also find links in the description to check the live gold price, inflation charts, and yield data for yourself. Remember, if today's price of $2,440 per ounce jumps even slightly in the next few days, that could be an early signal of a bullish breakout. If it holds steady or slips below $2,400, expect sideways action or maybe some short-term pressure. Thanks so much for watching, everyone. In our next video, we'll explore the difference between physical gold, gold ETFs, and gold mining stocks. See you there.